I would say this has been the mildest end of cycle that we've seen in 40 years, in fact, in my whole career. So, there have been a couple of classic things like distress. I mean, it is there, but it's nowhere near as much as we saw as in the great financial crisis or, after the tech crash or, that really big crash that we had in the early 90s. Nowhere near as much. And
Mhm.
that's because, let's say, the last three real estate end of cycle events, sort of 89, 2000, 2006, were all accompanied with a macro crash, the end of the macro cycle. Here we've got the end of a real estate cycle, but no end of the macro cycle.
Hi, Adam Gower here, founder of gowercrowd.com and host of this podcast and YouTube series, Real Estate Market Watch, Current Events Through a Real Estate Lens. My guest today is Richard Barkham, who up until last week was the Global Chief Economist at CBRE. Richard has a lifetime of experience in commercial real estate and macroeconomics and also real estate economics. He's professor of the practice at UNC and senior fellow and lecturer in real estate at Harvard University. He also has done some lecturing at my alma mater, University College London. And in our conversation today, we really look at various intersections between the macroeconomic world and the commercial real estate cycle. It's a very interesting perspective that he has that actually contradicts the intuitive understanding that I've always had that the commercial real estate cycle parallels pretty closely the macroeconomic world. So you're going to hear a little about some of the nuances that Richard sees in that, his views on the recently passed big, beautiful tax bill. Certainly reassuring for me, who has taken a very gloomy outlook at where we're headed. So you will, if you don't take that perspective, you're going to find his insights and thoughts very reassuring. And we talk about some of the asset classes that he sees are likely to be particularly strong and those that are potentially weaker than others in our conversation. If you have not already subscribed to my newsletter, please go to gowercrowd.com. There's a subscribe button there. Of course, you can always unsubscribe, but I do summarize these conversations, as I will do with Richard's as well today, in written format so that you can read and learn a little that way, as well as listening or watching to the podcast itself. All there at gowercrowd.com. Just hit the subscribe button. Okay, without further ado, let's move on to Richard Barkham, former Global Chief Economist at CBRE. Here he is. Richard, how fabulous to see you. Thank you so much for joining me. Well, this is, I kind of jokingly say, this is your first day off, isn't it? For probably hundreds of years. Who are you? What's your background? What did you do at CBRE, past tense? And I have to ask also, because I did do a sneaky bit of research, what did you teach at UCL, my alma mater?
Well, okay. So I was Global Head of Research and Global Chief Economist for CBRE, the world's largest real estate services company. And on June the 30th, I retired from that job, having not done hundreds of years, but having done 11 years at CBRE, and then, but pretty much hard at it for 40 years. And I don't intend to retire from work, but I'm quite enjoying getting up and not having to do something that I don't want to do. So I'm going to take some time out and see what's out there. So that's just you asked about my teaching background. Actually, I prior to CBRE, I was 14 years at Grosvenor. And prior to that, I was a professor at the University of Reading. So I did most of my teaching at the University of Reading in the UK. And I've subsequently become an honorary professor at University College London. And I help out at the Bartlett School of Sustainable Construction. and I occasionally give lectures in real estate economics. My academic career, insofar as I've got one, I'm a professor of practice at University of North Carolina, and I'm a senior fellow and lecturer in real estate at Harvard. So I think I've just answered your question and given you a mini resume, in the same breath.
Well, thank you so much. I really appreciate it. And I did like that we had that. Obviously, we have national connections as well, but that connection through UCL.
To me, a lot of Americans haven't heard of UCL, but
That's right.
they've heard of LSE. I'm sure you're all too familiar with that. I mean, I give lectures at LSE, and after the lectures, the students come up with their CVs or their business cards. If I give a lecture at UCL, the students come up afterwards and ask interesting questions. They ask complex questions. So to my mind, I have the greatest regard for UCL as an institution. It is a fine, fine university, and it attracts really interesting students as well.
Oh, I love that you say that. It's actually where I got my PhD, so I'm always happy to see that.
So which department were you in, if you don't mind?
My PhD was in history.
Uh-huh.
I looked at the financing of the Russo-Japanese War by American bankers and underwrote. I looked at how they underwrote risk. So that's how I did. It was actually what do you call it? It was a research PhD. So I had to do a lot of research. But anyway, that's all about me. Today is all about you. So let me ask you.
Of course, yeah.
So thank you, by the way, thank you also for joining me on a day when the first day you could get up and not do what you didn't want to do. So I'm very glad that you're here with me, hopefully doing something that you like to do. So my first question, the day after, almost 30 days after, yeah, the day after, or a few days after your retirement, a tax bill was passed in the United States, as you know, and I know you mentioned that you were in Dallas, so you're very much US facing. A tax bill was passed. So what are the highlights of that, Richard, from a commercial real estate perspective? I know it's a big question, but what are the main things that you see in there that will be impactful on the industry?
Well, I mean, I double as a macroeconomist as well as a real estate economist. So I think in terms of the immediate macro consequences or the consequences for the US economy, I think they're probably quite positive. There's a degree of stimulus in that bill, which I think, we're seeing a certain amount of slowing in the US economy. Not much. It's been very resilient, but I think the passage of the bill will allow a certain amount of certainty, confidence, and stimulus to boost growth, I think, over the next 12 to 18 to 24 months. And of course, all real estate, it is a derived demand, and it's derived from the demand for the production of goods and services. To give a classic economics answer, so if the economy is doing well, I think we'll find that real estate is doing well. So that's number one consequence. If I could throw it, but I, like most people, I'm a bit concerned that some of the spending is unfunded by tax. So it'll have to be funded by borrowing, and that's adding to the US national debt. So I mean, some people would argue that the economy will grow quick enough that the growth of GDP and nominal GDP will outstrip the growth of debt. I don't know that I would believe that particularly much. I don't think the growth in the national debt is an urgent issue. The US isn't going to fall over. The US can sustain that level of debt. But, the higher the debt to GDP ratio goes, the more upward pressure there is on the 10-year Treasury, which is the base kind of pricing parameter for commercial real estate. So, I'm a bit concerned that, that the tax bill will boost growth, but it will also, keep the 10-year Treasury, in the 4.5 range, rather than seeing it drift down into the 3.5 range, which I think is the equilibrium in the longer term.
Right, and that is completely out of the Federal Reserve's hands, isn't it? It doesn't really matter what they do if the so-called bond vigilantes keep 10-year treasuries at a certain level, there's nothing that the Fed can do. Is that right?
Well, that's right. I mean, the long end of the curve is it's totally market driven. It's not completely true. I mean, the Fed could set monetary policy too tight and put the economy into recession, and that would probably bring back down the 10-year treasury. So it's not completely out with the hands of the Fed, but I don't think that's not within their mandate. They obviously got the Fed funds rate, and I think they'll be looking at some of the tariff, the consequences of tariff, and the consequences of the stimulus that are coming through the bill, and saying, we're on top of inflation as far as we can see, but conditions are a little bit uncertain. So I think they'll probably be, taking their time before they reduce the Fed funds rate.
So is this, taking something of a cynical perspective, Richard, but is this kind of a classic presidential move to stimulate the economy while they're in office, at least for the period that they're in office, and not really care about what happens once they leave?
I think I don't know if it's classically presidential. I mean, it is an abiding feature of kind of short, the electoral cycle. Politicians will always want to stimulate the economy. I think if we one way you can see it, I mean, if you want to get, it's kind of part of the policy package that you see with populist governments. They tend not to be, tend to be socially conservative and fiscally liberal. So it's all part of a kind of a kind of populist movement, and I think we've seen it in the UK to a certain extent. Although Europe, I would say, is done a little bit more to try and balance the books. They don't have the kind of the heft in world markets that the United States does. But I think in a broader context, it might also be, an unfolding and continuing reaction to, the years of austerity that kind of followed the great financial crisis. I think a lot of the politics that we have now is there was that decade after the great financial crisis was a tough decade. In terms of either in the United States, the private sector was rebuilding its balance sheet. In the case of Europe, public sector was kind of, had all of those austerity policies. So I think people just got fed up of austerity in one form or another, and a little bit more, inclined to, politicians are a bit more inclined to fiscal liberalism. It won't last. Somebody will have to, to balance the books at some point or another. But I don't think the political will is there for that at the moment.
No, and as far as I can recall, it's not been there since Clinton. I think did he balance the books, didn't he, at one point?
He balanced the books, but I think no, that's right. He did. Whether he did that deliberately or whether he just had tax revenues from a kind of a very buoyant economy that and a kind of very accommodative Fed and a long boom to do that. I don't know, but somebody will have to bring the balance between tax and revenue a little bit more into line in the United States than they're doing at the moment.
Okay, so the tax bill is stimulatory.
Yep.
So that's good for commercial real estate. But you've also spoken a lot about the debt wall, haven't you? $950 billion of maturing CRE debt this year. How do you see financing risk and actually lender behavior in the impact on asset pricing and repricing and the industry overall, particularly in the context of this bill?
Well, I mean, I didn't refer to the debt wall. I referred to the kind of fiscal, the national debt. Okay. But of course, there is an ongoing process of, financing and refinancing real estate. And I'm a little, a little bit out of date. I think, maybe a month on the most up to date market conditions. But when I last looked, I think banks were continuing to be ready to lend to real estate, and there's continued appetite. I think some of the deregulation, the banking deregulation in the bill might even give more appetite from the banks. The only place that I see a little bit of caution, I think, from the banks is in the construction sector. We know that in the multifamily and the industrial sector, there's still a wave of supply that needs to be absorbed, and it's being absorbed. Albeit that industrial vacancy is still rising. But I think outside of construction lending, I think banks are still willing to lend to real estate. And this kind of wall of maturities that people point to, the 950 million, and it first pointed it in 2021. And then then it got pushed to 22 to 23. And I'm not saying that banks are extending and pretending, but I think there has been a willingness on the part of the banks to work with borrowers, and where assets, it may have lost 30% in value, but vacancy rates haven't risen very much. So the assets themselves can still service loans in terms of the net operating income. The values might have dropped. Where assets can do that, I think banks have been very willing to extend loans. There might have been some cash in refinancing, but banks have been very, very unwilling to take loans back. So, the 950 million or $1 billion, I think it'll get pushed to next year, and it'll gradually erode as real estate is refinanced, albeit at higher interest rates than the loans that were put in place in the sort of 2018 to 23 period.
Yeah, it's a very pragmatic perspective. I remember the global financial crisis, where banks were mandated to market their entire portfolios. That hasn't happened this time, has it? And so that's allowed for greater stamina to weather any economic headwinds that the banks have been facing this time. Would you agree?
Yes, and I think banks are not as exposed. You've got to be a little bit careful. I think, what really caused the great financial crisis was not commercial real estate. Now, commercial real estate had a bad time, but in the great financial crisis, it was actually the residential market that brought the banks down. And the residential market is as strong as it's ever been, really. So, and the residential market's 4 times the size of the commercial real estate market. So the pressure from real estate broadly defined on the banking system is nowhere near what it was in the great financial crisis. And I think it's a tendency in the American industry for values to drift down slowly. They don't get marked to market that quickly, partly because of the appraisal profession's way of working, understandable way of working. So I don't think it's just the fact that banks haven't had to mark to market. I think the real estate market is fundamentally way healthier than it was, and even within commercial real estate. In the great financial crisis, kind of vacancy went up in multifamily and the office sector. Really, in the commercial real estate sector, it's only the 25% of that, which is the office sector, that has really suffered. Everything else is in good form. So, I think banks could be, justifiably more relaxed. Plus, they've got better capital buffers than they always, they had previously. Plus, they've been provisioning against it over the last 18 months. The press refers to the wall of debt, but I think it's a non-issue, frankly.
Yeah, it's interesting. I must confess to having been swept up by the tidal wave of gloom, but deep down do actually see the points that you're making uh, you know, being valid and influencing the market a lot more than the likelihood of a significant downturn. I am interested.
I'm not saying there aren't issues. I mean, it could have
Okay.
gone a different direction. When SVB went down, when we had that little minor wave of bank crises, I think back in 2022, then I think the issue is not the fundamental assets, it's the deposit flight. But the Fed, I think, had its great financial crisis playbook, out it intervened like a day later. It didn't wait for 3 months. It opened the liquidity window, and behind the scenes, it was telling the banks, go easy, on real estate borrowers, even if the asset values are falling. So I think the Fed intervened very aggressively, very quickly. And then, since then, the top 50 banks have provisioned, I think something like 120, probably maybe by now 150 billion. There are, I think, still issues in the community and regional banks, but they're not financially, or they're not systematically important banks. I think there's still a bit of clearing up to do in the regional and community banks. But as I say, I think it would also may have been a bit worse if there'd been a problem in the multifamily sector. But multifamily net absorption in Q1, I think, was the highest on record, or the highest in 20 years. And I think the banks have been able to cope with the atrocious conditions in the office sector, because it's only 25% of commercial real estate, and commercial real estate is only 30% of the overall stock of real estate, including owner-occupied housing.
So you mentioned banking deregulation a few minutes ago, that is certainly part of the Trump administration's policies, but also perhaps woven into the bill that was passed or signed into law on Friday. What are those? What is the banking deregulation that you're talking about? What will be the impact, and what is the potential downside of that also?
Well, I mean, I haven't had, it's a big, beautiful bill that takes a lot of reading, and I can't probably give the detail on it. But I think it will be around in not having to hold so much capital, with regard to a loan portfolio in real estate. So I think, one of the features of, if I were to predict, one of the features of the last cycle, from great financial crisis onwards, was that the bigger banks were a bit more cautious on lending to commercial real estate. And so that's why the community and regional banks, took up that market share, and why actually we've had a growth of non-bank financial institutions lending to real estate. I think that the larger banks will have more flexibility, to lend to real estate. So I think, you will see the larger banks growing their market share of lending to real estate. What is the impact? I think probably not much in the short term. If it becomes, if the big banks start fighting with each other for market share and you get very aggressive lending, then I think that's something we would want to watch for. But at the moment, I think for real estate folks who are seeking to raise debt capital, it just broadens the source of that, which is good for market liquidity.
So what about the impact of trade tariffs and uncertain Fed direction? How do these policy shifts influence the industry, Richard?
I think
these are relatively new, aren't they? You've been in this industry for a long time, and this is all new. Actually, there's not many examples that are quite the same, are there? Throughout both.
No. I mean, I was kind of academically active and watching when, if we go back to 1979, Mrs. Thatcher started deregulating the economy. And at that point, it was sort of taking capital controls away. Um, I think we're seeing a little bit more of a deglobalization, a re-regulation of the economy. And I think, the tariffs haven't had much impact for the time being, but I think they will probably be, inflationary. I also think they may well have some success in causing manufacturing activity to relocate to the United States, but the United States is a high-cost location, so costs of goods will go up, and I think it'll take a while for the Fed to just make sure that initial impact from the tariffs doesn't feed through into second round and third round inflation, and they'll be a bit more cautious about bringing interest rates down. So I think it's probably pushed interest rates are probably heading down, but it's weakened that downward trajectory and pushed it out a little bit.
Right. We also had these incredible employment data as well, didn't we, coming in for what was it? Was last month, right? They had
June probably.
Yeah.
145,000 jobs, well above the 110,000 that people expected. And it's really remarkable just how resilient. Now, if you look at the numbers, what you'll find is it's not much the private sector that's hiring at the moment. Private sector is not really laying off workers, but it's not really taking them on either. So it's a bit neutral. What we're seeing is healthcare, government, state and local government type jobs, and I think part of it is just a rebound. Those state and local government and the healthcare jobs were so badly hit by COVID. But I don't know, we're in 2025. It feels a bit late to be talking about COVID rebound. I just wonder if we're seeing, the other big trend, or one of the other big trends, is just the retirement of the baby boom generation. Yeah. So you're seeing all these jobs created in the health sector, and I just wonder if it's demographics unfolding as well. Yeah. So you've got a structural shift. In any case, jobs are jobs. It makes consumers feel secure, and it underpins continued reasonably buoyant, or reasonably, I wouldn't say buoyant, but reasonably stable consumer spending, which is the bedrock. That's where we are. It is remarkable just how resilient the labour market has been, given that interest rates have been so high for so long.
Yeah, it is interesting, and it's also interesting that you pick up on that health sector hiring trend and connect the dots to the baby boomers, because that is certainly an asset class that seems to me to have tailwinds that are so strong that they can that they're likely to outpace any kind of other macroeconomic challenges that there may be at a policy level, for example, just because there are so many people retiring and reaching their last heaviest medical demand years of their lives, including senior housing, etc. So how do you see that affecting?
Let's not get too carried away. I mean, I think the boomers will be retiring, will sort of be 64 and sort of years old, somewhere between 60 and 70, maybe a bit older, a bit younger. Right. The interesting trend to pick up there is actually those are prime age travellers. So if you're looking at for sectors that are going to benefit from that boomer retirement, have a look at travel and everything from kind of Airbnb to different hotel types, as well as that. I'd say the millennials as well are probably big travellers, and they're delaying starting families. So I think some of the demographics points to and you can see if you look at if you go to Europe, it's full of Americans. With great respect, we love Americans, but they're traveling like there's no tomorrow. Oddly enough, Europeans and Asians are not coming to the United States quite as much as they were, but Americans are traveling quite a lot. But as you know, but nevertheless, the health seems to be, for reasons that because of COVID, because of aging. I wouldn't disagree that too has got an absolute tailwind in that sector.
Richard, where are we in the cycle? The real estate cycle.
Well, I would say,
yes.
Okay, the real estate cycle is easy. The macro cycle much more tricky because that was, heavily disturbed by COVID, and I think I'd say we're probably mid-cycle macro. Mid to late cycle macro, but we're actually start of a new cycle in real estate. So I think, we pretty much over the course of 23 and 24, the real estate cycle that kicked off in 2014 came to an end. And you can see it in a whole lot of variables. You can see it in rising vacancy rates. Now, I've said vacancy rates didn't rise that much. But they did rise in multifamily. They're coming in. They're still rising in industrial, not to particularly aggressive levels, but they've shot up from 12 to 20% in the office sector. And retail, oddly enough, is the only sector that's escaped a rise in vacancy. Plus, we've also had, a drop in values of 25 to 30%. And plus, we've also had a real scale back in new construction. So those are all characteristics of the end of cycle. I think the cycle came, to an end well and truly. And we've also seen capital markets investment activity, pretty much. It's hit rock bottom. It's been bouncing along the bottom. It's trending up a little bit now. But I think we're at the start of a new real estate cycle. And that probably starts now. Now, the real estate cycle is a long cycle. So, don't expect, start of a real estate cycle, it could take another 7 or 8 years to play out in its entirety, 4 minimum, 8 maximum, but we are definitely at the start of a new cycle.
Right. So start of a new cycle, meaning we're bouncing along the bottom and picking up, right? That's how you would define it.
I would say that, vacancy rates, they've risen, but they're kind of stabilizing and beginning to edge down. There's not enough, decline in vacancy rates to generate significant rental pressure, except in 1 or 2 locations. New construction has ground to a halt. The other feature of the start of a cycle, the end of a cycle, is that there's a lot of flight to quality. So, we've got all of the inventory from the last cycle, particularly in the industrial sector, particularly in multifamily. So people are, and even within the office sector, people are, moving out of the older assets into the newer assets. That always defines the start of a cycle. And when the good quality product, runs out, then people start moving to sort of grade B plus and grade B minus and so on and so forth. And then suddenly people see, well, we've run out of new space. Time to kick off some development again. But we're not there at the moment.
Yeah, but you also see distress as well, don't you? Late cycle, like people lose wealth transfer. That's a classic sign of an end of a cycle, isn't it?
Yes, I would say this has been the mildest end of cycle that we've seen in 40 years. In fact, in my whole career. So, there have been a couple of classic things like distress. I mean, it is there, but it's nowhere near as much as we saw as in the great financial crisis or, after the tech crash. Or, that really big crash that we had in the early 90s. Nowhere near as much. And that's because, if you want to get really technical, the last sort of let's say the last 3 real estate end of cycle events, sort of 89, 2000, 2006, were all accompanied with a macro crash, the end of the macro cycle. Here we've got the end of a real estate cycle, but no end of the macro cycle. So, it's been a relatively benign end of cycle. We haven't seen that kind of financial stress, that kind of transfer of assets to the banks and thence to, kind of new capital coming into the market. We haven't seen that at all.
Richard's fascinating perspective you've got here. By the way, tell me if you're starting to think that you've had enough. All right, I'll wrap up. But
I'm happy to keep talking for another few minutes. I just got a frog in my throat.
All right, no problem. If you want to get a slug of something, feel free. All right. So this is an interesting perspective, actually. So I've always thought of the real estate cycle as being closely related to the macroeconomic cycle. So to me, it's counterintuitive that we could be at the bottom of a real estate cycle and just slowly pulling out. If the macroeconomy is mid-cycle, that suggests that it will go down while the real estate cycle is going up. But aren't those contradictory?
No, I mean, there is, because part of the driver of the real estate cycle is the kind of user demand for real estate, occupier demand, and that's driven by the macro cycle. But the real, if you go back to kind of basic fundamentals, the real disturber of real estate markets is the kind of build up in new supply. Mid to the end of the cycle, people kind of overproduce real estate, and I suspect that's what we've seen, and that's what's having some impact on the rising vacancy is much more to do with the delivery of new stock. So there is a close link between the macro cycle and the real estate cycle, and it's very odd to see this end of real estate cycle play out when there's no end of macro cycle. Does that mean that the next real estate cycle is likely to be disturbed by an end of macro cycle halfway up? Yeah, it probably is. So, I mean, I think real estate is very investable right now, particularly if, like me, you are worried that inflation, we might be in a higher inflation environment with the stimulus, with the pressure on the Fed politically to bring down interest rates. Then I think it is a good time to invest in real estate. I think investors ought to put more of their portfolio in real estate. Indeed, that's what I intend to do myself. However, you have got to watch out for that hiccup that's going to come when we get the inevitable recession in the macroeconomy, which probably sometime in the next 24, 36 months, I would say.
Right. Obviously the best way to defend against that is keep your debt low. I'm sure you'd agree with that.
Yes, that's right. I mean, absolutely right. Keep your leverage, which is not the way that real estate investing takes place in the United States. But keep your debt low, focus on prime grade assets, make sure that you're not just being cyclical, you're being structural, invest in the sectors that have the tailwinds of demographics, of technology, behind them. And just watch out, and just watch the kind of tenant exposure, the types of tenants that you've got, and how vulnerable are they to a consumer downturn, because that's what it will be. You have to watch the sensitivity of your real estate to a consumer downturn.
Right, I have 3 sign-off questions, but before I ask them, those are quick rapid fire questions, so we can wrap up. But before I ask that, are there any major opportunities or challenges you see facing the industry, something that people should be aware of or underwriting to, thinking about in the coming months? Anything major?
Yeah, I mean, I don't think it's anything new. The growth of the digital economy is just powering away, and that one you might think that just means invest in data centers, but I don't think it's just about that. I think it's about how people are living their lives, how they're working. So I think following the hybrid working story, I think, is going to be key to successful real estate investing going forward. And it doesn't only mean that people are going to be working remotely, because there's some retreat from that right now. But I think you have to keep an eye on kind of where people are living and working and how they're working, and that helps you to decide. And the healthcare, I think, is digital economy, aging. Those are key themes.
Okay, so let's wrap up. Rapid fire questions. What are the 2 or 3 market signals that you watch to give you early warning signals of shifts in the industry?
I always look at the labour market. Just how many jobs are being generated. American economists tend to look at employment growth. I tend to look at the unemployment rate. We gloomy Europeans look at unemployment. So I follow very carefully, the balance of hiring and firing in the economy. And somewhere, all of these signals change over time. But you have got to keep an eye on that. And I think also real interest rates as well. That's an economist's trend. The difference between the nominal rate and the expected rate of inflation. Those two things are things that I keep a close eye on.
Just explain that to me, actually. The nominal rate versus the rate of inflation. What are those, actually?
Well, you know what the rate of
inflation is. Yes, obviously.
And you can think about inflation in the past, or you can think about what people expect in the future. And there are lots of different ways. There are surveys of expected inflation, but what really affects asset values in the long run is the real rate of interest. So if the Fed funds rate is at 4.5% and inflation is 4%, then you've got a 0.5% real interest rate. But if the rate of inflation drops to 2%, then you've got a 2.5% real interest rate. So, I think inflation has been surprising on the downside, even with tariffs. And so people ought to be looking at the real interest rate as a guide to the financial stress that might be building up on the economy. But if that's a bit complex, keep a close eye on the labour market, and it's not just the amount of jobs. 145,000 jobs sounds good, but where are those jobs being created? What is the corporate sector doing in terms of job generation? Those are things I would be looking at.
Okay, last question. So what political or market developments do you track that would perhaps cause you to rethink your assumptions about where both the macro and commercial real estate markets are headed?
I think I've always taken the view that individual political events are not really that important. But this is where we came in. This kind of trend to fiscal liberalism, is a bit reminiscent of the 1970s. Of the high point of Keynesian economics, where you would spend and spend to create high pressure and deliver, high employment and wage growth. I think we've drifted back into that, and I think, although we can't see it at the moment, I suspect might be, down the road some inflationary consequences. Now, real estate tends to do quite well over the long term, not necessarily in a 6-month or a 12-month period, but if you're thinking that might be an outcome, you probably want to be upweighting real assets, of which real estate is, eminently suitable.
Richard Barkham, what an enormous pleasure to meet you. Former Global Chief Economist at CBRE. Thanks for joining me today.
Absolute pleasure. Good luck.
All right, that was Richard Barkham, former Global Chief Economist at CBRE. Richard, what a pleasure to meet you. Thank you so much for joining me today on one of your first days off, actually having retired. Oh my goodness, how I envy you that. Anyway, so it was good to see you. Thanks for joining me, and thanks for sharing your insights into what's going on. You did give me a really good boost of optimism. Not sure if that was your intent. Of course, a little bit off the record as well, that just reassured me that I'm not totally on the wrong lines with the way I think things are going. But nevertheless, what's coming out of the tax bill, where real estate's headed, and how that might intersect with the with the general macroeconomy was extremely interesting to me. And so thank you actually for sharing those thoughts with me today. And thank you to listeners and viewers for joining us. I'm sure that you also got some insights out of Richard's perspective that perhaps are novel to you about where we're headed. Certainly was that experience for me. So thanks for joining us. And if it weren't for you, we would be nothing here. So thank you so much. I really appreciate your time spent with me today. Of course, if you've not subscribed to the newsletter, go to gowercrowd.com, hit subscribe, sign up for that, and you'll get written summaries of these podcasts all there, totally free. You can always unsubscribe. Okay, gowercrowd.com. All right, that's it for this episode. Thank you so much, everybody, for joining me. Richard, thank you again. And until next time, this is Adam Gower signing off.